Hey everyone, what's up? It's Shi'Ree, and this is lesson 2 of my Printing Money Forex training course. In this lesson, we will be going over how to trade using risk management and how to create a trading plan made for you and especially you. Okay, first, what is risk management? Risk management is knowing how to properly manage the risk of your trades to avoid losing a big portion of your account in the event of a loss. Why is proper risk management important? One, you cannot win every trade. No one does. Therefore, learning proper risk management is needed. I don't win every trade. You're not going to win every trade. Even, traders more successful than me don't win every trade. It's just something that you're going to have to accept as a trader. If you cannot accept that, then trading is not for you, okay? Using proper risk management helps you avoid blowing your account, as well as losing big portions of your account in the event of a loss. Okay, again, we can't avoid the losses, you just have to take them. Proper risk management also helps decrease your drawdowns while increasing your profits, okay? So if you're using proper risk management, those trades that you do lose, you're not going to suffer that much of a drawdown because you're using proper risk management. Okay? Here is a chart that I have of proper versus improper risk management. To the left, I have the proper risk management chart, and to the right, I have an improper risk management chart. Okay? As you can see on both of these accounts, they started with an account balance of $500, okay? Trade 1. And these are trades that we lost, okay? Let's just say these 5 were our losing streak. Okay, account 1 is trading proper risk management, risking only 2% of their account. Okay? The table to the right is obviously using improper risk management, risking 15% of their account. Okay? After their series of losing trades, 5 losing trades, look at where the improper risk management account balance is at. $261. You lost 47% of your account in 5 trades because you were trading with improper risk management. Okay, and let's see to the right, the trader that was using proper risk management, after their little drawdown of 5 bad trades, look where their account is now sitting at, $461.20. Proper risk management, after after losing 5 trades, or improper risk management, and lose a lot of your account. The key to proper risk management is to never risk more than 2 to 5% of your account. Never. I know you're probably wondering, how much does it take to break even after a loss? You lose 10% of your capital, as you can see right here on the chart. You have to gain back 11% in order to break even. Another example, like the previous example, how they lost 47%, that's basically 50%, okay? So that person that was using the improper risk management, I'm sorry, it is so late, I'm up doing these videos for you guys. So the person that used improper risk management would need to gain 100% in order to break even. The more you lose, obviously the harder it is going to be to make it back. That's why you should use proper risk management. That's why you need to use proper risk management. Okay? When you trade without risk management, you are gambling. This is not a gambling business. You treat it like gambling, you're going to lose a lot of money. Okay? When you trade without risk management, it's way more easier to blow accounts. I don't know how many accounts I've personally blown trying to keep up with others' profits, okay? Not trading the proper lot sizes of my account balance, which therefore was improper risk management, okay? With improper risk management, or you not using it at all, you are more than likely to have huge losses. Why? Because you're not planning. You have to plan. If you fail to plan, you are basically planning to fail. Okay? When you trade without risk management, your drawdown will more than likely increase as well. This is trading. You're going to win some and you're going to lose some. The main idea is for your wins to heavily outweigh your losses. Okay? You do not want your losses outweighing your wins because obviously you're not making any profits. What is a drawdown? A drawdown is the reduction of one's capital after a series of losing trades. Okay? So let's say you were on a winning streak. You just won your last 20 trades. And then all of a sudden you lose your next 8. Those 8 that you lost caused a drawdown in your account, okay? So let's say if we were looking at a price chart, after those 20 trades that you took were successful, you would be at a high. Then the following 8 ones, you would see that price drop, obviously, okay? Drawdowns are normally calculated by finding the difference between what your account was initially at before the losses and afterwards. For example, let's say you started with $500. You lost $172 that day. 172 divided by 500 is 34%. Your drawdown for that day was 34%. Traders keep track of their drawdown by using percentages, okay? And this is very important to keep track of. Track record for yourself. A lot of times you can go back and view these things and find out what you are doing wrong, and you can work on obviously fixing it and preventing it from happening in the future. I'm sorry guys, I've been working so hard on this training, and excuse my heater in the background. I'm not sure if you'll be able to hear it or not. But this is a slide of a drawdown. And this is what your equity curve would look like, or does look like, when you trade without risk management, okay? As you can see, this is considered a downtrend. You don't want that as far as drawdowns. Okay, and this is a drawdown with proper risk management. As you can see, these little drawdowns, but overall, your equity is rising. Okay, you're gaining equity, and that's exactly what you want as a trader. Smaller drawdowns, higher profits. Now we're going to go over a risk to reward ratio. Okay? A risk to reward ratio is the amount you are looking to risk in the event of a loss in return of the amount you are looking to gain if your trade is successful, okay? Risk to reward ratios help increase your chances of profitability. What you want to do is trade nothing smaller than a 1 to 2, meaning do not take the risk if the reward isn't at least 2 times the risk. Okay? Keep it simple. Trading is as simple as you make it. A lot of you guys tend to overcomplicate trading. One is your mindset, okay? Like I went over in the psychology lesson. 2 is trading with improper risk management. And 3 is you don't have a trading plan. Okay, and that's why I'm giving you guys this knowledge for you guys to get on the right track so you can start progressing, not only as traders, but in your life as a whole. Okay, once you find a good setup, you want to determine what your risk to reward is. Okay, you want to choose your stop loss and at least 2 targets to get your ratio. Based on your ratio, how many pips you are looking to risk in return of how many you are looking to gain, find the right lot size in order for you to use proper risk management in the event that you may get stop out, because again, like I said, we cannot win them all, and successful traders know that, but they don't let that bother them. Okay, here is an example of a pre-planned risk to reward ratio. Okay, in this example, target 1, which is this right here, isn't a 1-to-2 ratio. As you see, this is the risk area. This was the odd Jappy 4-hour chart. Okay, so price is right here, and let's say we were looking for entry right here. Okay, we would place our stop above the last swing low or high, depending on what the trend is. Okay, in this example, this is a downtrend. We would have placed our stops below this last swing low, and once again looked for entry in this area. Okay, target 1 was not exactly a 1-to-2 risk to reward ratio, but people would have still taken it because it was higher than a 1-to-1. Okay, target 2 and 3 are perfect examples of good risk to reward, which is higher than a 1-to-2. You do this before entering a trade. Okay, so before you actually would have entered into this trade, you would have drawn or written down your risk to reward ratios. Okay, example, let's say our account balance was at $1,300. We only want to risk 2% of $1,300, which would be $26. Therefore, we want to risk no more than $26 when we enter this trade. Okay, you do the math. Let's say I'm using a 5 lot, which equals 50 cents a pip, which would mean if you were to take this trade looking for entry in this area, risking 91.5 pips, if you were to use a 0.05 lot, you would be risking $47.50, which is higher than $26. So you then go down to a smaller lot size, and you would have come to the conclusion that you would have either used a 3 lot or a 2 lot. A 3 lot was just, $1.45 over $26. So a lot of you may have taken it, and there are a lot of more disciplined traders out there that would have just took their lot down to a 0.02 to only risk $18.30, which is less than $26. As you can see, our proper lot size in this example would be a 3 lot or lower if you're only willing to risk 2% of your account. Okay, in this area, you want to target support and resistance areas. You don't want to just target the out and open. And what I do when I'm looking to target areas is look at how price previously acted. Look to the left. Price will not tell you a lie. Okay, and here is the chart progress. Look at that. Perfect example of using good risk to reward. And if this is a trade that you would have analyzed and figured it was good enough to enter, you could have caught over 195 plus pips so far while using proper risk management. In this again was odd jabby 4 hour, and I actually screenshotted and added these pictures a few days ago, but now it went up a whole lot higher. So you could have well made over 195 pips so far while you were using the proper risk management. Okay? Tip: always, 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 always use a stop. And something that a lot of you need to learn how to do is to move your stops, okay? When you are a certain amount of pips, whichever you personally prefer, in profit, move your stops to break even to remove all risk. Move your stops to break even to remove all risk. What do I mean by move your stops to break even? Move your stop to where as though it is above your price, above your entry price in an uptrend, or below your entry price in a downtrend. Okay? Why do you want to do this? You want to do this because if price reverses, it will hit your stop loss and you will still be closed out in profit. You do not want to see a trade that was well in profit reverse on you just to hit your stop and knock you out with losses, all because you didn't move your stop to the right area. Okay? For example, once you hit target 1, you can move your stop. And that is if you prefer to move it once price hits that area. Again, if you want to move your stop once it's 10 pips in profit, then do what fits and works best for you. Okay? A lot of people tend to wait for price to hit their target 1 and then they'll close half of their position. If that's a rule of yours that you choose to have, then more power to you. You're trading, you need to have your own set of rules that you follow in order for your plan to work for you. Okay? Longer term trades, you're going to want to use lower lots. In shorter term, it's okay to use higher lots and, target less pips. Another key thing in risk management, I see a lot of people that demo with $100,000 accounts, $50,000 accounts, yet they don't have this kind of equity to start with in Forex, okay? If you're looking to become a profitable trader, but you are like me, for instance, I'm a mother of 2. I don't have money. I'm sorry, I didn't have the money to just throw in an account and possibly lose. Okay? I didn't have that. Therefore, I had to trade more carefully. A lot of people tend to get used to those demo account lot sizes, $100,000 account, $10 lots, or 10 full lots, what you would properly say. And they're wondering why their accounts are getting blown immediately. That's because you're trading with unrealistic lots to your account size. And that's why I suggest to always, always, always demo with a realistic account balance. Preferably the amount you plan to trade live. In order to help you learn how to trade that account balance properly with risk management. If you're trading a $100,000 demo account and you go live with $100, you're more than likely not going to know what proper lot sizes to use. Again, this is when risk management comes into play. No matter what system you use, you will eventually have a losing streak. This is why risk management is so important. This also helps with your emotions. If you are using lower lot sizes, your emotions will not come into play as much, okay? And will actually help build confidence. As a trader, you must accept drawdowns, or trading, again, is not for you, as I stated earlier. Use the proper risk management to survive the drawdowns. And most importantly, create a trading plan that has proper risk management and stick to it. Okay? Now we are going to go over creating a trading plan. What is a trading plan? Trading plans define what is supposed to be done, how, when, and why. Okay? If you fail to plan, as I stated earlier, you are planning to fail. Again, if you fail to plan, you are planning to fail. Be your own trader and make your own rules. Rules that work for you. Don't follow anyone else's trading advice blindly, meaning don't just take trades because someone else says so, especially if it does not meet your method or plan requirements. Okay, that's where a lot of people tend to mess up, is they'll blindly take trades, or they'll take a trade because someone else called a trade out, even though it was against their analysis. They'll take that trade and then end up losing money. Don't be that trader. Be your own trader, and again, make your own rules that you consistently follow. Do not try keeping up with everyone else's profits. Trade properly with your balance. Trying to keep up with everyone else's profits and trading improperly with your balance is an easy, fast way to get your account blown. If you're going to do that, just hand your money over to the market, honestly. Just because someone else's method or plan works for them doesn't necessarily mean it will work for you unless it's very similar to yours. This is where mindset comes to play, as we discussed in the previous lesson, psychology. You may, again, have a very profitable system. Little do you know, but it's your mindset that's holding you back, okay? So this person's plan that you are trying to learn can work wonders for them. And you try and it may not work for you. But guess what? It's more than likely your mindset that's holding you back. And of course you have to practice. Don't go live unless you back test these methods. Don't go live until you demo these methods. Or you're just asking to lose money, okay? If you're jumping in the market not knowing what you're doing, a lot of emotion is going to come into play, which is going to make you close out trades early and lose profits. Okay, what you need to do is create your own plan and stick to it. This helps minimize your mistakes. Okay? Self-discipline involves the development of the mind that allows you to stay focused amongst mistakes. Okay, and I had down here, we'll discuss more in psychology lesson, but that lesson is already over. That was the previous lesson before this. So again, you guys already know that self-discipline involves the development of the mind, which allows you to stay focused amongst mistakes. You do not want to trade with emotions. Okay? In your trading plan, first you want to recognize your trader personality. Then you want to write down your personal expectations, your risk management rules, trading methods and entry checklists, and last but not least, your trading log. Trader personality. Excuse my furnace in the back if you do hear it. I'm not sure if you guys will or will not, but again, if you do, please excuse it. Trader personality. What type of trader are you? Are you a scalper? Scalpers typically target small pips and quick profits, usually in and out of the market in a short period of time. Okay? Day traders typically like to trade day to day. Positions are usually closed before the market closes at the end of that trading day, which is 5 p.m. Eastern time, okay? And swing traders, they look and trade longer term trades, typically held for days or more, okay? Personal expectations. What are your goals? These are very important to know and stick to. Include daily, weekly, monthly, and yearly goals in your trading plan. Once you hit your daily goal, let's say you're trading, well, of course you have to be trading. But once you hit your daily goal or go above it, just call it a day. Don't overtrade. You don't want to give the market back what you just took off of them. Okay? Also, make sure you keep track of your goals, your progress, and keep track of all of your trades and things in a trading log. In your personal expectations, you want to include your why. Why did you start trading? This helps to look back upon during those hard times you may be having, those hard trading days, those losing days. Your reason why is what should keep you going and motivated no matter what. No matter if you just had a whole week or two of losing trades. No matter if you just blown an account again. That why should keep you motivated and focused on the goal. Things don't happen overnight. Not saying they can't, but great things don't happen overnight. Write realistic goals with the time frames, because when you achieve them, you will feel extremely proud of yourself, which will help boost your trading confidence. Okay? In the section for your risk management rules, you will write them down and stick to your personal risk management rules. Don't just write them down to write them down. Write them down and stick to them. Follow the proper risk management rules as stated earlier in the presentation. Never, ever, ever risk more than 2 to 5% of your account. Yes, it is okay to have an extra risk account that you trade more aggressively with. But always, always, always follow proper risk on your main trading accounts to avoid huge drawdowns or blowing your account. Okay? In your trading plan, under the trading methods and rules section, you will write down all the methods you personally prefer to trade and will only consider to enter a trade if you have at least 3 confirmations minimum. Okay, so for example, a trader may want to see support and resistance, price action patterns, trend lines, harmonics, divergence, etc. Whatever else they would have on their list of methods. If they had at least 3 of those confirmations, they would consider entering the trade after determining if the risk management is proper. Or not even, I don't even want to exactly say proper if the risk management isn't at least 1 to 2. Okay? Also, write down the times you prefer to trade. Don't trade all day. Don't sit in front of the charts all day. We're aiming for freedom. What freedom are you having if you're just sitting in front of your computer all day looking at charts? Learn how to only trade certain times of the day. For example, if you're writing a rule down, let's say you don't want to trade after 12 p.m., then write that as a rule. Do not enter any trades after 12 p.m. If you're making a rule, make sure you are following it, or it could cost you. It could cost you greatly. Okay? Your entry checklist. You want to use your entry checklist before entering trades and keep track of them all, because they can help you identify why you lost the trades you did and help you to try avoid making the mistake again. This checklist will fit you personally. And an example, you may have mood. Am I in the right mind state to trade? And this is something that you would check upon before looking at the charts and while looking at the charts. Okay? You're asking yourself as you're reading these questions going down your checklist. Is there any divergence on the 1 hour or higher? Is there a double bottom? Support and resistance area? Okay. If confirmed, or if looking for entry, what's my risk to reward? And etc. These entry checklists can come in very much handy because you see your rules and things written down. Writing things down are more effective. I am so sorry, guys. I been tongue-tied so many words. I've been up for the past 24 hours. I'm working my behind off to get this stuff to you guys, and I'm sure you will love it, okay? Sorry, I got off topic. Anyways, as far as your trading log, you want to keep record of everything. Again, so you can go back and analyze your weak and strong areas, and you can focus on strengthening the weak. Okay? In your trading log, for example, you want to write down the pair, the entry price, the exit price, your stop loss, the time, the day, session, of course, how you felt when you were taking the trade. Was it a successful or unsuccessful trade? And what would you change next time? Again, keep these lists. They can help you spot your weak areas, and then you can target those areas and fix them to help you grow into a more profitable trader. Alright guys, homework. What I want you to do is create your own trading plan by following the knowledge given in this presentation. Practice proper risk management on a demo account. Backtest these methods, which will come in the following videos. Anything that I show you, I want you guys to backtest. Don't just jump in and go live. Follow your trading plan on a demo account first and keep track of your successes. Keep track of your success and failures to help find your weak areas once again. Guys, I love seeing results, and I'm sure you will love showing them, so feel free to email me. You can also email me anything that you want me to overlook or analyze, give my opinion on. So feel free to email, message me, tag me to your results, and things like that. I'll definitely be sure to congratulate you and show some love. Alright guys, this is the end of our risk management and creating a proper trading plan. Let's kill the markets, guys, and once again, don't just take these things and not apply them. Take it, soak in the knowledge, and apply it. You are looking to be a more profitable trader. That will not happen if you just sit there. Take action. All right, guys, let's print this money and kill the markets this year.